So Keisha, you've been looking at some international news as you usually do. You're our foreign link. So ratings agency Moody downgraded 10 U.S. banks and put the credit ratings of 6 others on review. What does this mean for markets?
So recall earlier this year we had Silicon Valley Bank and Signature Bank going under. Moody's, a credit rating agency in the US, they regularly review different companies, and they're saying, no, well, we think several of these smaller US banks are at risk. And so they've downgraded the credit ratings for these banks, basically saying, watch out because their capital adequacy may be an issue. And the fact that, interest rates keep going higher, in a tighter financial conditions, that could create problems at the bank. So essentially what happened because of that, prices have started falling in the US a bit since last week when Moody's came out. So that's it in a nutshell. Prices are kind of turning over in the US because of the news from Moody's.
So does it seem likely that Moody's is likely to eventually downgrade those institutions?
Well, they've downgraded 10 of them already.
Right. So there's another 6 that's,
negative
put their ratings on review. So are those likely to be downgraded as well?
Likely they may come. Also, the bigger banks, your JP Morgan, your Wells Fargo, the bigger banks, they're what everyone's worried about because those banks, now if we see credit rating downgrades for those banks, that's really when we're going to see a bigger hit to stock prices. And we've already started seeing that reaction where the share prices for these larger banks have started falling as well.
And
for context as well. Hold on, David. Is this a repercussion from the downgrade of the U.S. credit rating? Like America as a country, their credit rating was downgraded, were downgraded by Fitch recently. So does this have anything to do with that?
Connected, but not a direct result of it, but connected because these banks are very large portions of the U.S. economy. And so coming from that rating downgrade for the U.S., it is connected to the small, because what got downgraded by Moody's are the small banks and the medium-sized banks, with rating watches from other banks coming and possibly now the big banks. So it's connected, but it just means that watch out on the US because there are signs of stress that we're seeing.
Mm-hmm. Go ahead, David. You wanted to add something?
No, I was referring to the same Moody's. Moody's Fitch downgraded the US debt from AAA down to AA. And you're just seeing further stress indicators in the system.
Right.
And the reality is, we saw where Pacific West, remember I mentioned a couple of months ago, Kalilah? I think that was back in May, I mentioned them. Pacific West, has proposed a merger with another Californian bank. And, this came, just a couple months after your Silicon Valley Bank, your Republic Bank, your Credit Suisse, and they, were in talks of, trying to consider a sale, and the stock price crashed that day. The regional banking stocks fell considerably during that period, and we're seeing another casualty of this high interest rate environment. And the thing is, we're likely to see, potentially more banks just go under, which causes other repercussions in the long term, because whereas, these larger banks like a JP Morgan will come in and say, hey, we're happy to just get one of these smaller players, the larger investor loan book and reach for us. But the thing is, some of these smaller banks cater specifically to certain niches. So like in Jamaica, we all say, oh, the banks don't rate we hurt a business or this or anything like that. So like Silicon Valley Bank, for example, they were catered towards the tech sector and those startups. Republic was geared towards the rich and illustrious, and you have these different regional and smaller banks that are geared towards meeting the needs of their community or in their region. And with this rating downgrade, there's going to be further impact for somebody to even raise debt or just other means of funding to assist their books. Because what happened after the events of Silicon Valley Bank and Republic Bank was that person said, wait, these guys might have issues in short order. Let me take my deposits from Bank A and carry it to a Bank B like a JP Morgan or Wells Fargo, which I deem too big to fail, and at least I know that way, if things go wrong at them, I'm safe. So that's created an additional piece of form of stress in the system, whereby deposits, which are your cheaper source of funding, are moving from your smaller banks to your larger banks, which is causing this further ripple cycle to this occur. So it's just a very precarious and dangerous situation going in the USA right now.
Not
No,
David,
from
not so
the
full
regional
on.
side. From the regional
Yes,
side.
signs of stress, but I wouldn't say, precarious, dangerous. Because the thing is, remember, the US, the government stepped in to say we're gonna guarantee all the deposits. So that was a big move coming from them. So it helps a bit, but there are still problems from a capital adequacy perspective. So stress, yes, but I wouldn't say no, danger or so, but signs of stress for sure that we want to be mindful of.
No, consider for sure, and we just have to sit back and watch carefully,
Right.
because
Yeah.
For in case of other financial stocks, like even last week, Upstart, buy now pay later firm, they saw the revenue create a 40% year over year. And I'm just kind of starting to buy a put option that let me go from $5 to more than $16 US, which is from 500 US to basically 1,600 US dollars. But the reality is, financial companies are really feeling the brunt of the higher rate environment.
Mm-hmm.
And we just have to be very observant, because when the Silicon Valley Bank event did occur, we saw all these major US companies, these tech companies say, wait, we have a good chunk of money for Silicon Valley Bank. We're well above the FDIC threshold of $200,000. And this is just one of the other kind of consequences of, a bank failure that people don't seem to realize. Even though the deposits might be guaranteed, that gap that might occur from, you getting access back to your deposits from the bank can cause your own issues in your own business. It won't mean you collapse, but it can cause further stress, and it also creates other issues for you to go and seek new funding to take care of your own capital needs, because even locally here we're seeing where different companies in a range of sectors are feeling the impact of rising finance costs.
Mm-hmm. Interesting. Well, definitely something to keep our eye on. Thanks for bringing it to our attention, Keisha.